What's up guys, Adrian here and welcome to another video in my monthly series where I present my dividend stock picks of the month. So the stock market is kind of in a holding pattern right now with a lot of the March and April of volatility behind us. This is evident when we look at the volatility index, simply called the VIX, which is an index that tracks volatility in the US stock market. So as you can see from the graph, the market is a lot more stable now, but definitely not back to normal levels before the pandemic, even though we had a significant recovery overall. So just a quick disclaimer before I unveil my picks for the month. I'm not a certified financial advisor or have any financial education whatsoever. However, I've been investing on my own since 2012 and currently have a dividend portfolio of about $625,000, which is currently generating about $1,000 a week in passive income. So starting in 2018, I switched my investment strategy to focus exclusively on stocks and funds that provide a dividend. So all my stock picks will, one, have a dividend, and two, are stocks that I own myself. So I definitely consider myself an income investor, which means the most important thing for me is getting safe, consistent, and stable passive income via dividends every single month. So I am also a value investor at heart, which means I always look for cheap and undervalued stocks, which tend to have nice, juicy dividends. So my stock picks will definitely reflect my personal strategy. This strategy has allowed my wife and I to become financially independent in 2019 at 34 and 37 years old, which means that our passive income pays off all our living expenses every single month. So if ever you're interested in seeing my dividend stock portfolio or my retirement account, which is completely separate from one another, make sure to check out those videos in my channel. So without further ado, let's check out my picks for the month of August. Alright, so pick number one is called the Covered Call Utilities ETF. Stock symbol is ZWU. So this is managed by BMO, one of the biggest covered call ETF managers in Canada. The dividend payout is monthly. So this ETF, just like the name says, holds big cap or blue chip utilities, telecom, and pipeline companies all over North America. So a very safe and a defensive sector of the stock market because everyone needs their utilities, everyone needs their voice and data services and their energy via pipelines. So this ETF uses a covered call strategy to boost the dividend yield. If you don't know what a covered call strategy is, make sure to check out the video I made recently, which explains that strategy in detail. So if we look at the most recent price of $11.98, it's currently providing a dividend yield of about 8%, which is really good for such a safe and stable sector. If we compare that to the 1-year high of $14.78, it was only which was only giving 6.5%, you see that there's a really nice incentive to buy it at this price. So if we just look quickly at the breakdown, you see that 53% is utilities or power generation, electricity, 26% telecom, so voice and data, so cell phone, internet, and 21% energy, but pipeline companies, so not oil and gas producers or anything like that. So my key points and reasoning of why this is a pick this month, it's a very safe and defensive sector of the stock market because everyone needs their power, everyone needs their voice and data services. This ETF actually has a low to medium risk rating from BMO, so that just proves that it's safe. BMO is a really reliable fund manager. They have a lot of ETFs that they've been doing it a long time. Very undervalued because you're getting an easy and stable 8% yield. Also, it's a covered call ETF, so it has good performance during volatility because of the covered calls. And this ETF holds some of the Canadian and US dividend aristocrats, a lot of names that we all know. On the Canadian side, you have names like Bell, TELUS, Enbridge, Emera, Fortis. And on the US side, you have AT&T, Verizon, which are big telecoms, and PPL, Duke Energy, and a couple more, which are a really big utility company. So a very safe 8% yield here, in my opinion. So pick number two is also a covered call ETF. It's the US and Canada Lifeco ETF. The fund manager is CI First Asset. Stock symbol is FLI. So the dividend payout is quarterly instead of monthly. So like the name says, this ETF holds the 10 biggest life insurance companies or Lifecos in North America, and also uses a covered call strategy to boost the dividend yield. So if we look at the share price right now, it's $7.69, which translates to a really high dividend yield of 11.18%. And if we compare that to the 1-year high price, it was $11.85, only giving a dividend yield of 7.26. So you could see there's a really big discount here. So here's the breakdown. You have 7 Lifecos based in the US, including MetLife, a really big one, and 3 based in Canada. So the ones based in Canada are the 3 biggest ones: Manulife, Sun Life, and Great West Lifeco. So my key points and reasoning for this pick is that the financial sector is really suffering right now because of COVID-19. Financial stocks will take a lot longer to recover compared to other sectors of the market, like technology, for example. So life insurance companies are actually part of the financial sector. So in my opinion, it's a very cheap and undervalued ETF. Life insurance companies have a really robust and bulletproof business model if you compare them to banks. And with this ETF, you have exposure to only the biggest and best ones in North America. So you don't have to pick and choose individual stocks. So you have convenience with this ETF as well as a huge 11% dividend yield, of course. Also, because of the covered calls, you have good performance during volatility. By the way, I recently made a video covering life insurance companies overall and how to invest in them, and I went into detail about this ETF, so make sure to check it out if you're interested in investing in this ETF. Alright, so pick number 3 needs no introduction. It's Enbridge. So the stock symbol is ENB. The dividend payout is quarterly. So Enbridge, like we all know, is Canada's biggest energy infrastructure company that includes a network of crude oil, liquids, and natural gas pipelines, regulated natural gas distribution utilities, and renewable power generation. So they actually transport 25% of all the crude oil produced in North America and 20% of all the natural gas consumed in US. So a really big player. Also, they have renewable energy that includes onshore and offshore wind, solar, and geothermal projects in North America and Europe. So if we take a look at the stock price, most recent one of $43.52, a really nice discount compared to the 1-year high. So right now you're getting an approximate dividend yield of 7.44%. If we compare the stock price to the 1-year high, it was $57.32, or where you would only get a 5.65% dividend yield. So you could see here a really nice discount right now. So for my key points and reasoning, Enbridge has a legendary and a growing dividend. It's currently at 7.4% right now, but they have a good track record of increasing their dividend every year, which is fantastic. Also, they have not done any dividend cuts or reductions because of COVID-19. They recently announced their September dividend, which is good news. And also don't forget that Enbridge is a midstream company, so they're much safer than oil and gas producers. So yes, it is considered an energy company, but they manage the infrastructure, not the actual oil and gas production. So crude oil prices has a much less impact on them than oil and gas producers. Also, they're expanding into renewable energy, so this gives me confidence for the future. And just in terms of numbers, they're huge. So this is the 3rd biggest Canadian corporation in Canada that gives a dividend. So they're currently worth about $85 billion, and it is the biggest energy company in Canada. Also, some good news, they recently announced their Q2 results on July 29th, and they actually beat estimates, so the results were really good. So in my opinion, a really good entry point here for investors, because I think it's very cheap and undervalued right now, and who knows what the future holds for Enbridge, especially that they're getting into renewable energy. Alright guys, so my last pick number 4 is Nexus REIT. Stock symbol is NXR.UN. So this is, they give a monthly dividend. So Nexus REIT is a small cap REIT in Canada. It's a commercial REIT, so they own 37 industrial properties, 22 retail, and 15 office properties. It was created a while ago by combining 2 REITs, so Nobel REIT and Edgefront REIT, and it's currently listed on the TSX Venture or the TSXV, but they are planning to apply buy to graduate to the TSX at the end of September 2020. So let's look at the stock price. It's currently trading at about $1.45, which translates into an enormous dividend yield of a little over 11%. If we compare that to the 1-year high of $2.35, you're getting a really significant discount now, because back then with the 1-year high you're only getting 6.81%. So you're almost doubling your yield compared to the 1-year high if you pick up this stock right now. My key points and reasoning for this one: this REIT is focused on industrial properties, which are safer than retail and office properties. Obviously, the enormous 11% dividend yield. I think that this is a very cheap and undervalued stock because COVID-19 affected all REITs. REITs are having a really hard time right now, especially ones that have retail properties with all the mandatory retail store closures. But because this has a lot of industrial properties, I think it's really undervalued and cheap right now. So they released their Q1 results a few months ago, and they were really reassuring. Their dividend payout ratio was only 81%, which is really good. It just means anything under 100% means they're able to sustain the dividend. So I have some quotes from the CEO from the Q1 results. He said that our prudent capital structure has put us in a position to weather the storm. We expect to be able to maintain our distribution policy, or our dividend policy. So really reassuring in terms of the dividend here. Also, they recently sent another update to shareholders on July 22nd, and it was also positive. They said that they received 87% of rents from April to July, which is fairly high if you compare them to other REITs, and they already declared their August and September dividend without a dividend cut or reduction. So a really nice, lesser known small cap REIT here, which I think is a really good pick this month, because they're focused on industrial properties, and I don't think that they will cut or reduce the dividend. But either way, let's say they cut it in half, let's say worst comes to worst, you're still booking a nice 5.5% dividend yield, which is still great. So those are my stock picks for the month of August. I hope you enjoyed them and decide to invest so you too could enjoy making easy passive income. So please hit that like button and let me know if you agree or disagree with any of my stock picks, or if you have any stock picks of your own you would like to share. I'll be more than happy to check those out and provide my opinion. And finally, make sure you subscribe not to miss out on my future stock picks of the month, as well as my other content. So take care guys, and see you next time.